Our next guest says the weak two-year note auction reflects a bunker mentality among investors. Mike Schumacher is head of macro strategy at Wells Fargo Securities. Mike, great to see you, as always. So why are bond investors in the bunker and stock investors are like out walking the streets, having fun? You know, I mean, like there's such a contrast
going out
between
to
the two.
dinner.
Right.
Yeah, great question. I think on the bond side, people don't even know what the Fed's next move is going to be. It's not like we're debating 25 or 50 basis points of hikes or cuts. It's hike or cut, can't tell. So it's really not a great environment to buy a really short-term Treasury security. I think it's got people spooked, frankly.
Why do stock investors, you think, not care that the next move is a coin toss almost?
Yeah, it's interesting. When you think about the idea of the equity market maybe not getting support out of the Fed, perhaps people are saying, well, you got a bit of inflation. That's pretty clear. It's going to be here for X number of months. It's not automatically bad for earnings. So earnings typically do well in an inflationary environment. So I think you've got some support there on that side built in. Bond people don't have that. So I can understand a bit of a disconnect.
Does it even matter what the Fed does at this point? The market's been raising rates for them. We talked before the show. That two-year auction was a disaster in a word.
And the 30-year mortgage is, what, 640, something like that now? So the market's been penalizing the economy quite a bit. The Fed always matters. But right now, in particular, can the Fed really do anything? Would it want to? I doubt it. You've got a new chairman coming in, whether it's in a couple months or maybe 3 or 4 months, who can say exactly. But it's really difficult to imagine the Fed doing anything different for a while. So I think it's on hold. It matters, but right now it's kind of stuck.
Yeah, so, Mike, you just mentioned like corporate earnings in an inflationary environment usually do pretty well. But what do you think of the backdrop? And Karen used the word before, it's stagflationary environment. Mm-hmm. You know, we have a weakening labor market. We have higher interest rates. You know, we have a scenario where, you know, inflation and the higher input costs for consumers that are 2/3 of the GDP are really likely to have an impact. I mean, is it a scenario where when you do have weakening growth, maybe it's not great for equities in an environment where, you know, a lot of people think that this is just a hiccup on the way to getting back to a bull market? And it probably is, because that's the way it goes. I think at the lows yesterday, the S&P was down 8% from its all-time highs. And every year, on average, we have about a 10% decline. We haven't had one since last April. So I'm just curious where you think about, like, what does a stagflationary environment look like? And I suspect you think it's not great for risk assets like stocks.
Stagflation would be terrible. There's just no getting around that. But the question is, are we there yet? I would say not. So we're going to see high inflation for a while. There's damage built into the system. You mentioned 2022. Yeah, we got through it. How did the S&P do that year? Down 20%. How did the bond market do? Maybe down 15. Nothing won. So that was a very bad, pretty recent example. But a stagflationary environment is just all around terrible for risk assets and not very good for fixed income. But it's a timing thing. I guess it always is in markets. But still, how quickly do we go from, this is kind of uncomfortable, to, gee, it's a full-blown stagflation? I suspect it's another quarter or two. Not yet.
So just to get to the stagflation, beside the definition, what really is stagflation? What's enough growth to sort of stay out of the stag part, but still have deflation? Where could we sort of be okay?
I think if you're sub 1% growth, that's going to feel pretty bad. Doesn't have to be negative, sort of a tipping point, but anything below 1 in the U.S., that'll be pretty grim, I would say, for the outlook ahead.
So when you look at the overall market and you look at the Fed's choices, and I think you touched on this in your opening remarks, there's really nothing they can do at this juncture right now, right? There's no good choices that they have because they don't have anything in their toolbox to help what they perceive as this supply shock. And when you said it's really not 2022, what is your best comparison to that? Where are you looking through the end of the tunnel?
Yeah, right now, I'd say as far as the Fed goes, agreed, no good choice. So the best choice for the Fed, frankly, is sit and wait. Get more data, get more information. The Fed isn't really compelled to act right now. It doesn't have to. Why should it? What the Fed can do on the margin is keep liquidity in the system. So this is kind of arcane. The Fed's buying a bunch of T-bills. It props up liquidity. Why slow down? There's no reason to. So keep that going. Do things like that are pretty simple, but don't change the policy rate until it gets more data. So as far as a comparator, there's not a great one. You can look at a number of historical examples, which are fairly dark, I'd say, and there's really not one that fits perfectly. So I think right now we can't even say exactly where this is going. Got to wait another month or two, probably.